Hi, good evening, everyone. Thank you for joining us for today's technical analysis session. My name is Vivian from Century Financial. I'm head market consultant at Century. Welcome to each one of you all. Today, we'll be looking at technical analysis and we will be looking at two technical tools that will help you identify opportunities. At the same time, it will help you to avoid, minimize your risk and increase your profitability on every decision that you're going to make. So let's dive right into it. What is technical analysis? Okay, before we move on to the session, I also just want to request you all at the end of the session, if you all have learned more and if it has been more of value added to your knowledge, please do give us a review, and your review would be much appreciated. Now, let's look at what is technical analysis. So, basically, there are two types of analysis any trader or an investor would do. Uh, One is technical analysis, the other side is a fundamental analysis. What is a fundamental analysis? Fundamental analysis is nothing but, for example, let's say we are looking at a stock. In this example, let's say we are looking at Microsoft. Now we understand fundamentally Microsoft is a good company. Now what all goes while doing your studies on fundamentals for Microsoft? It'll be looking at their profit and loss. It's looking at their financials year on year, quarter on quarter, to see their progress over the years. And every time Microsoft happens to beat their sales and increase their profitability, it is a much more valuable company and fundamentally a strong company which is consistently making profits. That is one side of the financials. The other side is what is the service or what is the product that Microsoft actually sells, and what is the market competition for Microsoft at this point of time. So you do deep analysis of every aspect to see if the business is worth buying into, and will the business sustain in the long run, and what kind of potential it can have from a medium to long term time frame. Now, knowing Microsoft, we all use Microsoft on a daily basis, most of us at least do, and we understand their services, we understand their product, we also understand the market share that they've captured around the world, because most of the companies, everyone use Microsoft, hence it becomes a fundamentally strong company. Now, just because a company is fundamentally strong, that does not mean that it is a right time to buy into a company. So we need to look at certain levels before we enter any particular trade or investment. Now, definitely, although we know Microsoft has been performing quite strong for a long time, that does not mean we might have to end up buying into Microsoft right today. How about what if we get a discount on Microsoft? Let's say Microsoft comes down, the stock value drops down by 10%. Now, that would be a very good investment opportunity for someone to get into rather than buying right at the top. So, what technical analysis helps us do is identify these opportunities. It helps us to identify a good price or a good discount that you can possibly think of investing, and using certain tools which gives you an indication where you feel the drop is ending and you feel the market is going to go back up. Now you need to have some solid reasons before you enter any market, or good logic before you enter into any market. And technical analysis helps you solve that problem. It helps you identify a potential reversal zone. At the same time, technical analysis also will help you identify the best price to enter, the best price to avoid entering, the prices to avoid entering, and the best price to book your profits or to minimize your losses in case the market starts going against you. So, in short, technical analysis basically looks at the previous price movement. So, technical analysis has nothing to do with the fundamentals. It is purely based on the historical price movement. So I can look at the last 2 hours of movement on a particular instrument, and see what the technical levels are showing me for a short term trade. At the same time, I can look at the levels on maybe last 2 months or even last 2 years to understand where the particular price is, and at what price is it a good level to actually think of investing or putting your money into. So let's look at the examples on the two indicators that we'll be discussing today. One is the relative strength index. In the meanwhile, if any of you all have any questions, please do write in the chat box. I will try and answer as much as possible. I hope all of you all can hear me. I'm guessing you can because I'm not getting any messages, so that is good. So I'll continue. Relative strength index is basically a oscillator. So I will show you a couple of examples on what oscillator means. An oscillator, by definition, you understand it oscillates between two range. When you look at the markets, or if you look at any stock price or any instrument, like even for cryptos, you understand that the market goes up, market drops, and market makes a new high, or maybe it makes a new low, but market's always either trending up or trending down. You never see a range bound market where the market goes, let's say for example, there's a stock at a price of 100, and let's say the stock goes up to 150, then the stock comes back to 120, and then again it goes back to 150, again it comes back to 120. You do not see this sideways movement in a stock market, because stock markets always tend to grow with value. So hence the prices also grow. Maybe today the stock is $100, maybe 2 years later the stock might be at 200 or $250. So that is a trending market. But when it comes to an oscillator always ranges between two levels, and that is what relative strength index is. So relative strength index basically takes into consideration of all the price movement that happens. Let's say you can give a time frame of 21 days, you can give a time frame of 21 weeks, you can also give a time frame of 21 years. Depending on the time frame that you're looking at, it shows you the momentum of strength in the market. We'll not get into how RSI is calculated. You can do a small YouTube video on that to understand how the calculation behind the RSI goes. But let's look at using RSI. What do we derive out of an RSI? Moving forward, let me show you a couple of examples as well. Now, this is basically SPX 500. For those of you who have not used a platform, this is how the chart on the platform looks. If you still have not started with us, you can always request for a demo account. And for those of you who has already been trading with us, I'm sure you're already used to the platform. But for those of you who are new, this is the chart, and this is where you find your technicals. Now, technicals are the tools that we use to identify opportunities in the market. Now, once you click on technicals, we go to studies. There are a lot of technical indicators that is over here, which you don't have to worry about right now. We are going to be mainly focusing on RSI. Once you go to studies, you will find RSI. You click on RSI, and you find your RSI opening at the bottom of the chart. So earlier you see this is your candlesticks. Basically, this is on a weekly time frame. You saw the market come down, market has gone up. Each candlestick represents a move of a single week. Okay. And the minute you click on RSI, you see an RSI opening right at the bottom of the chart on the same candlesticks that you had seen earlier. Now, when I say oscillator, RSI will always oscillate between this blue line on top and this orange line at the bottom. So every time RSI goes up, so the blue line and the orange line, extreme on top is 100%, extreme at the bottom is 0. So your orange line is 30%, whereas your blue line is 70%. Now, every time the market goes above, let's say the strength has picked up, the momentum has picked up and has gone above 70%, it is known as the market is being overbought. Basically, you could see an exhaustion in the buyers, and at any point of time you might see sellers coming back and taking control of the market. Whereas in this case, probably sorry, this was the pandemic drop. Definitely the crash happened because of the pandemic. But however, irrespective of what was happening in the market, if you have to just look at a technical tool without seeing the fundamentals into it, even then the market was shown overbought, and the signal was already there even before the market crash happened. So in in few stances, your RSI will always help you to get ready to anticipate a downside in the market. Oops, let me just go back. Yeah. So in this case, RSI was showing you an overbought region, and then the market did drop when the RSI came to a oversold region. Basically, once it comes below the orange line, it is at oversold. Now, at this point of time is where all the buyers gear up to start buying back into the markets, because a drop like this is an opportunity for all the buyers. So as you can see, this was the pandemic drop, and after it has been oversold, you see the markets coming up, and at this point of time it's still going up. So RSI is just one indicator. You cannot just go on buy and sell on RSI. You need to understand the characteristics of each instrument, how many dollars the specific instrument can move. Like for example, you need to understand if it is Apple, the stock. How many dollars can Apple move in a day? How many dollars can Apple move in a week? How many dollars can Apple move in a year? So every time you take a decision, these are few calculations that you have to keep in mind, which I will show you on a couple of examples, which I will be showing you on the live chart. Let's move forward now. Coming to know about how many dollars a specific instrument moves. This is where our other technical indicator comes into play. So it is known as average true range. Again, pretty much it shows us how many dollars or how many points, if you're trading in currencies, how many pips can the specific instrument move. Again, ATR is calculated based on historical data. For example, let's say there is a stock which moves $10 on an average every day, irrespective of the direction. Let's say it has been moving $10 consistently for the last 30 days. So RSI as of today will show me that this particular stock can move $10 today, because it takes an average of the last 30 days and tells me how many dollars I can expect it to move for today based on the previous historical data. And that is what technical analysis is. But how does this data help me? Now, please bear in mind, this does not tell you the direction of the market. It only tells us how many dollars it can move. So the $10 can be on the upside, or the $10 could be on the lower end of the market. So it does not give you a signal in terms of buy or sell, but it just simply shows you how many dollars it can move. Let me show you an example again for ATR. Now, again, coming back to the chart, you go to your technicals, you click on technicals, then it goes to it opens up your studies, you click on studies, and it gives you ATR over here. So both your ATR and RSI could be found in studies if you're looking at it for the first time. Now, once you click on ATR also opens at the lower end. This is again the chart of SPX. For those of you who do not know what SPX is, SPX 500 is the index which has 500 companies put into one single index. So the index moves based on these 500 companies. So if you want to invest in 500 different companies, you can directly invest into SPX because it will reflect how the overall 500 companies of US work. Also, most of the market news or market is always measured up with SPX 500 being its benchmark. So any news that you read, if they're talking about markets going up, markets dropping, especially for the US sector, they will always refer to SPX 500 because it is a broader market which tracks the top 500 companies of US. And definitely, if the top 500 companies of US is doing strong, we understand the US economy is doing well, whereas the US stock market as well is doing well. In this case, you see the market all the way from 1995. I'm looking at a monthly time frame, so each candlestick represents single month. So you can see all the way from 1995 to where it has come as of last week. Now, if you look at the average true range, at one point in time, you see it was moving roughly around $80. When I say $80, we need to look at the time frame. I'm looking at a monthly time frame. So in a month, we can expect SPX to move about $80. Let's look at what is happening today. As of today, in a single month, SPX can move $236. Okay, in short, for example, let's say you happen to buy 1 unit of SPX. You can look at it move $236 in your favor, or it can also go against you by $236. It depends on the direction of the market is not determined by ATR, but irrespective of the direction, let's say you happen to have a buy. If it goes up, you can expect during the month for it to go up by $236 on an average. If it comes down, you can expect it to drop by $236, and that is what ATR shows us on the charts. Now, how do we combine ATR and how do we combine RSI, and how does ATR and RSI help us make a decision on a short term or on a long term or even for a very long term investment basis? I will show you a couple of examples how you can use both these tools to make to understand what is happening in the market and to understand what is a good level to actually be entering into the market. At the same time, it is equally important to understand when the market goes against us. We should always make sure there is risk management in place. No matter how many times the strategy has worked for you, it is always a must to keep risk management, because markets can suddenly turn based on what is happening in the current scenario. Last year it was the pandemic. This year we have China pulling down most of their own markets. That could end up into a ripple effect if it goes much worse for the property market over there in China. But nevertheless, that does not mean we have to be fearful of the markets. It's just that we need to be wise enough to know if a market drops to a certain level, what kind of action would you be taking, and at the same time, is that an opportunity for us to actually get into it? So these are few things that we can look at it on a practical side of it. I have a question: what should I set the interval in order for RSI and ATR to be accurate? Well, that's a very good question. It completely depends on the instrument type and also on the time frame type. Most commonly used is about 21 days average, on an average, to look at the markets. Okay, because last 21 days helps you at least to understand what is happening for the next 1 month, but you can always go much more in terms of the longer time frame. That completely depends on the instrument type as well. For example, Apple as a stock can move about 2 to 3%, but if you're trying to apply the same thing on a crypto market, probably crypto market usually moves about 5 to 10% on an average every day. So fine tuning should is required for each instrument. Once you understand your instrument well, and that is when you can understand what level of what time frame of RSI and ATR should be used. But for now, we'll keep it generic and see how this works out on a normal day when you're looking at a market. Now, few things that we need to understand with RSI also: you can always not just look at overbought or oversold. What we saw in the previous example, you saw when it is overbought, you sold it. When it was oversold, you thought of buying back into it. But that is just one indication. What if we can get 2 to 3 indications showing you a much more stronger signal? So it's always better to have 3 to 4 signals showing you a signal toward a direction rather than just depending on one single signal. However, even if you do depend on one single signal, risk management is a must at that point of time. So there is something known as divergence that occurs on an RSI and at the actual price movement in the market. So these divergence help you understand the strength in the market, and also it will help you understand if there is going to be a reversal that can take place in the market. Let's look at a couple of examples on this. So there are two types of divergence. One is the regular divergence, and the other one is the hidden divergence, and both of them have two biases. One is the bullish bias, that means we are expecting the markets to go up. The other side is the bearish bias, where we expect the market to come back down. Now let's move forward. Let's look at regular divergence. A regular divergence is used as a possible sign for a trend reversal. So anyone who is looking for a trend reversal will always be looking for a regular divergence, and I will give you a couple of examples on how a regular divergence look. Now there are two types of regular divergence, like we discussed: a bullish, expecting the market to go up; a bearish, basically expecting the market to come back down. Looking at the bullish divergence, here's a chart on Euro USD. It's a currency pair. Now, when you see the RSI picking up from the oversold zone. So you can see in this case, the RSI touched the oversold zone. And as the market, basically as the market has been going forward in time, you see the RSI is not coming back towards the lower end of the oscillator. It is making new lows, but it is making higher lows. So the lows are increasing, meaning every time the market is coming down, there is presence of a lot more strong buyers pushing the markets back up. At the same time, if you look at Euro USD, the price action. So here I'm looking at a line chart instead of a candlestick chart. Pretty much both of them shows the same thing. On a line chart, you do not understand, you don't get to see the open, high, low close of the day. But on a line chart, it just shows you the momentum that the price has been going on. In this case, you see every time it comes down significantly strong, but it has bounced back up. And these bounce back that you see are not because it was oversold. It is being bounced back because there are buyers much more stronger than sellers when it comes to lower levels. So every time you see a lower low on the price action and a higher low on the RSI, this is known as a regular bullish divergence. So to keep it visual, it will always look like a cone, but the opposite side. So the cone is widening towards the left side and the cone is narrowing towards the right side. Every time you find these kind of opportunities, that means there is a good chance that there is a trend reversal that is about to take place. So how do you determine at what point do I expect a trend reversal? Usually when you measure any trend lines or any of the lower lows, it should have minimum 2 to 3 touching points. So the more touching points are there, the stronger the signal could be. Okay. And for you to have a double confirmation whether you should enter, because a lot of people could enter even on this, but the problem is it still did come back down. So what you can do is you can wait for 3 dots to connect, basically 3 bottoms to connect over here, 3 top bottoms to connect again, and on the fourth drop you can take a buy. And of course this buy will also have stop losses and risk management in place irrespective of how the strong the signal is. Now this is on a bullish divergence. Now let's look at a reverse. A reverse is a bearish divergence. Basically now you're looking for an opportunity for the markets to drop. Okay, market is trending up, but you see RSI, once it went to overbought, it is not going back to overbought. It is coming back up, but it is making higher lows. Sorry, lower highs. So in this case, what happens is it is giving you the same shape, the cone. When I talk about the cone, I'm talking about these two lines over here. But in this case, the cone is widening. So that is one way to visually remember what a regular bearish divergence is. Again, 3 points on the upside, 3 points on the lower end. Then you can take a short position if you're a short seller in the market, or if you have buy positions already, it is time to at least consider closing most of your profits. And when the market comes back down, you can buy it back. For short sellers, the market drop would make profit for them and they can exit on the downside. So I hope you all are following me on this so far. If you all have any questions, please do write. We'll just take a 2 minutes break and I'll be back. If there's any questions in the meanwhile, please do write it in the chat. I'll just be back in 2 minutes. Hi, thank you all for waiting. Let's continue the session. We have a couple of questions. Can we see the focus on gold in the current scenario? Sure. We will look at it on the live charts. I hope you all can hear me. Please do drop in a message if you can hear me. Hope all of you all can hear me. Okay, perfect. Thank you. Thank you for the response. All right, let's move forward. And definitely, I will show you a couple of examples on the live chart. And since you've asked for gold in specific, let's look at even gold. Moving forward from your regular divergence, we also have something known as a hidden divergence. Now, the regular divergence is best used when trying to pick tops and bottoms. Basically, you're trying to pick the most bottom level to buy and the most topmost levels to book your profit or to short sell in the market. Now let's look at a hidden divergence. Divergence not only signal a potential trend reversal but can also be used to see if the trend continuation happens. And most of you all would have heard this that trend is your friend. So always be with the trend. You are much more safer. Going against the trend might be a little disastrous in case there is no risk management in place. But same thing, even going with the trend could be devastating in case there is no risk management. So either ways, irrespective of trend being a friend, risk management is always advised on every trade or every investment that you take. Now, coming to the risk management, I will also show you a couple of tips how to manage your risk, how to minimize your risk, and how to maximize your profit on the examples I'll be showing you in the future. Now, looking at a hidden bullish divergence. Now, we understand in a regular divergence, we are expecting the market to reverse. Whereas in a hidden bullish divergence, we are looking at the market to continue on its trend. Now you will see on a hidden bullish, again, it is a cone. Okay. But in this case, the cone basically, we are looking at a higher high in the price action. So every time the market went up and it came back down, it did not go below the previous low. So it made a higher high. Whereas on your RSI, it has made a lower low, technically indicating that there is a sign of exhaustion or there is a sign of oversold region. So a hidden divergence every time when it goes to a oversold region, like we saw in the very first example of RSI, we saw that every time it goes below this, it means buyers would come back and take control, and every time it is above the blue line, the sellers take in control. But in this bullish divergence, you have double signal, that is the trend is still intact towards the upside, whereas the RSI is coming to the oversold region. So when these two form, you get a second signal towards entering the market, and in this case the trend continuation, the market eventually continued going back up. So this is for a bullish divergence. Let's look at bearish divergence, pretty much the opposite. A bearish divergence is where you see higher lows, lower highs, and where you see on the RSI it makes a higher high. So technically over here you can see the price coming down. When it went back up, it did not breach the previous high, meaning there is not much strength left in the market for it to go above this. So the second time it started dropping. In the meanwhile, you see three times the RSI has come to the overbought region. So there, every time it has come to the overbought region and the market has taken its final breath, is where you see again the trend continuing back towards the downside. So technically, these might take a couple of practice session for you all to identify this on a live market. But what happens is once you practice, I would always recommend that you practice this on a demo account or even if you have a live account, I would always recommend that you practice it and write down your entry points and exit points based on the signals that you're going to see on these charts, and look at what price action happened. So once you do that, you become more familiar with these kind of patterns. At the same time, you will start identifying these patterns not just on one instrument. You will start identifying this on various instruments. So if there is no specific signal for today, you still have another 30 to 40 different instruments that you can look into to identify is there any trading opportunity. Now, key takeaways on this, as we know, regular divergence is basically a possible trend reversal, and hidden divergence gives you a signal for a possible trend continuation. Let's look at a live chart right now, going into the live chart. Let me just share the screen with you. All right, so basically, this, I hope most of you can see the terminal. Let's look at gold, since some of you were looking at gold. I'm just going to open the gold chart, opening a default template. Okay, right now I've opened a gold chart. I'm looking at the monthly time frame. Okay, now on your monthly time frame, I've opened RSI already, so you have your RSI. Let me also open the ATR. Now, for those of you who are very new to trading, how does the time frame matter? So usually, investor or a trader looks at a time frame to understand what kind of returns he can expect in what time frame. So anyone who looks at a monthly time frame is not looking for a return in a short term basis. They're looking for a return, or they're looking for an opportunity for a longer term basis. Because if you look at the monthly chart, let me try and make this a little bigger. Yeah. If you look at the monthly chart, you can go way back in time, all the way from 2000, and you can look at what is happening as of today. This will help an investor to take a good investment decision based on the monthly time frame that he's been seeing for years together. So if an investor decides to enter today, or if an investor is looking to find a good level to enter today, he would always look at it on a long term time frame, because he will be looking to make a return not in the next 2 days, not in the next 3 days. Probably a long term investor always looks at making a return at least for in the minimum 3 to 4 years time frame. Now, the same thing if we look at it on a daily chart. I'm just going to change it to a daily chart. Pretty much same. Now you can see on a daily chart, we are looking at historical data from 2016 only. If I make it a little, if I scroll into it, we'll come back to the ATR and RSI. If I scroll, yeah. So if I scroll into it, you will see from 2021 till date. So you've seen the markets dip, markets go back up, markets dip, markets go back up. There's a dip again, there's a upside again, there's a downside again. Now let's look at just this year on a daily time frame. And for those of you wondering who would look at a daily time frame, a person who is looking for a return probably in the next 1 to 2 weeks, or a daily time frame is also looked at to take a decision to make a return for maybe next 1 month or a little more than 1 month. So that's how a daily short term, sorry, this would come under a medium term investor who would look at taking advantage of maybe next 2 to 3 weeks, or maybe next 1 or 2 months. Daily time frame would give you a much better picture as to what to expect. Now let's look at our simple example on RSI on a daily chart. Okay. I'll just close ATR for now. We'll come back to the ATR. Now let's look at what has happened. I'm just increasing the size of the RSI so it's easier for all of us to see. Let me hide this. Let's start with the first time it went to overbought. right? You see the market went to the overbought region at this price here, these levels, and you see the market dropping. Then we see the market coming down to oversold over here. There was 3 points that touched over here, but this was extremely oversold. But however, let's also keep in mind the times it just touches. So in this case, you see it was overbought for the first time. It gave you a small spike. It came back overbought, gave you a small spike. It came overbought, oversold. I'm sorry, oversold the second time, and then you saw a market reversal eventually happen. So all of these small ones also are opportunities. This was the previous drop. I'm just going to be marking all of this so it's easier for you to understand. So when it came here, the prices were roughly around this level. So when it came here, the prices were at this level. And when it gave you the big oversold region, the prices were here. Now let's look at the upside again. Basically, this is the overbought region, market went flat, and then it gave you a drop. Oversold again. This was the oversold region, market went back up. Overbought, it did not go to overbought here, it did not. So I'm not going to consider this. So technically, we cannot expect a market to drop from here because we did not get a signal from RSI. Finally, it gave a oversold region at this price here. This was a quick crash that happened recently. For those who have been trading, you'll know why this happened. And at this point in time, the market is not oversold. So that means this price could probably continue coming down. So maybe it can come down further lower. Okay. So now very basic. Okay. Very basic to understand what overbought and oversold is. Now, just because it looks this easy on the chart, it's not that easy when you actually apply it. We need to consider few factors in this. In this case, let's say I took a sell. Let's look at one of the overbought region. Okay. Let's say in this case, or let's look at the buy side. So for those who are not comfortable on the sell side, let's look at the buy side. Okay. Now let's say this particular area over here. I'll make this bigger. Okay, so we understand at this level, we saw the market was oversold. Okay, and we decide to take a buy. Now, what happens? Let's say if somebody, let me just clear all of this and I'll put this back. I'm sorry, it just closed everything. RSI is back and my draw tools. Yeah. So I took a buy here because of the oversold region signal that it showed me. Okay, I took a buy here because of my signal here. But what technically happened over here is the buy signal pretty much came over in this region here at this price. Somewhere here is where it actually became oversold. What if somebody had to invest at this price over here? Let's say this white line, let me make this bigger as well. I'll make it a green line. Okay, let's say if an investor bought at this price and the market actually came down much more further after that, right? Now this is something nobody would anticipate because as per oversold, it is a time to buy. But the market did drop a little more. It dropped almost 2%. So if you had invested $100,000 in gold, you would have seen a loss of $2,000 on the downside. Now, let's say if you're a very new trader or if you're a very new investor, a loss of 2000 on one single trade or a loss of 2% on a single trade is too much to take in, because ideally you would be looking to make a return of 10 to 15% per annum, but your first trade itself is showing you a loss of 2%, and here you are in two minds. One is, should you be booking the loss? Second is, should you be holding on to it, hoping it comes back up? Now there are two things. If you held on to it hoping that it comes back, but it did not come, in this case where it dropped further, in this case after it showed overbought, the market pretty much continued dropping by 3%. So when a 3% drop happens, again you're going to be in a very panicky situation. So how do we know where to manage our risk when it goes against us, and how much of a space should we give before we do any kind of risk management? Let's look at an example. If we had to take a if we had to take a trade at that point of time, let's look at the price. So this blue line is basically where we got a signal on the RSI for being oversold. So technically this region became a good level to buy. So that is about 1789. Okay, let's say you invested $100,000, for example. Okay, since the account value is $10,000, let's say you invested $10,000 at this price, and the market came on the lower end by 2%. So 2% on $10,000 is about $200. But for a lot of people, $200 might not be a very big amount, but for a lot of you, it can be a very big amount on one single trade. So let's say if you have 5 trades making you 2% loss, you end up losing 10%. So every percentage drop is always needs to be calculated. Now, if I need to keep a stop loss, let's say in an area, I want to keep my risk management in such a way that it is less likely that you are wiped out from the market and high likely that you will make more returns. We need to understand how many dollars can gold move for that. And this is where ATR comes into play. So I'm going to be selecting ATR right now. Now we understand, we are looking at a daily chart, right? We are looking at a daily time frame, and we are looking to make a return. When you're looking at a daily time frame, you're always looking to make a return probably minimum 1 week. Okay, so in a single day, if gold moves about $22 at this point of time, gold was moving about $38 in a single day. Okay, roughly about $38. Now let me change this to a weekly time frame, because if my anticipation is for me to hold on to a week, I need to know in a week how many dollars can gold move. So in this case, on a weekly time frame, looking at the same thing on a weekly time frame, it shows gold can move about $55. Now what happens is, when I'm going to be taking a trade, or when I get a signal, in this case I got a signal to buy. Let's say the buy price was somewhere here. Let me close the green line. The blue line is the buy. Okay, the buy price is 1785, and I know since gold can move $55 during the week, I will always make sure I will keep a distance of $56 minimum. Sorry, 56. Yeah. Sorry, $56 away from the market. Okay. Now, in this case, what happens is, even after you took a buy, because you understood that in a weekly time frame the market can move $56, so you have given enough of space from where you had bought to keep your risk management. So in this case, what happens is, worst case scenario, gold continues dropping, you will lose $300. Okay, and the same way, you can put a take profit on the upside. You can keep about $56 on the upside. So in this case, it did not go up by $56, but nevertheless, it did not hit your stop loss as well. So why does ATR play an important role in your decision making? Because it helps me decide how many dollars should I keep my stop loss or my take profit on. In this case, if I have to keep my stop loss, let's say close by, to make a smaller loss, then the scenario would be it would have hit my stop loss and then the market went back in my favor. So to avoid such unwanted stop losses, but at the same time, it is important to keep your stop loss no matter how confident or how strong the signal might be. There is always a reason for you to keep a stop loss. I will show that to you in this particular trade here. Let me just close all of this. Let's look at what happened on this drop. Yeah. So when I got this drop here, technically, oops, sorry, it just zoomed out. Let me zoom that back in. Okay. So in this case, you see a overbought. I will put my you saw a oversold region on this particular candle here. This particular candle is where you came to a oversold region. Let's assume that a person looked at it at a oversold region at this price here, over here, exactly when it came to oversold, to take a buy position. It was not a very wrong move to take a buy when it is at oversold, but let's say this blue line is the price that the person bought it at 1760. Okay, and he has kept a stop loss as well. Now we understand market moves $56, right? And it can move back up $56. Sorry, $56. So let's say someone had invested about 10 units. So every time it goes, sorry, 10 units, yeah. So every time it goes up by $56, because that is your average true range on weekly, you make about $560. But every time it goes down, it'll make you a loss of $560. Now, in the case where, let's say, you did not keep a stop loss on this trade, and it continued going down, and pretty much it reversed from here, but at that point of time nobody will know if it is going to reverse. On a $10,000 account you'll be losing about $800, and because of the panic you might end up closing or you might end up buying more. But if you had a strict discipline of $56, the maximum you would have lost is $56. But then of course it depends on your risk appetite. If you're someone who cannot take $56 into 10 units as your stop loss, you can change your number of units. Let's say you can invest only 5 units. So in this case, if it drops by $56, you lose about $280. If it goes in your favor by $56, you make about $280. So this number of units is completely in the control of the client. Okay. But the danger is when, let's say, a bigger exposure is taken. Let's say with someone with a $10,000 account has taken a position worth 25 units. So 25 units is basically $44,000 investment on gold. Okay. And if at that point of time the investor or the trader has not kept any stop loss and the market dropped, he would have seen a loss of $2,000. And this is an example where the market actually goes back up. I will show you a couple of examples where after being oversold, the market can continue going down and probably it might reverse from a much more lower end. By then, your loss would have increased to $3,800 or $4,000, and your pretty much 40% of your investment is gone down in the market. And at that point of time, if you did have a stop loss, let's say at $56, your loss would have been big, maybe $1,400. But however, your loss also would have been limited in case there was a bigger drop. Now let's look at a scenario where the market drops and it continued dropping and does not come back up. I will show it to you on a weekly chart. Any questions so far? I will try and answer those questions in the next 1 or 2 minutes. Okay, not too much movement in gold. Let me show you on SPX. Okay. let's look at the pandemic drop. Let me do this on a daily chart because daily always is more preferred by most. Okay. So now this is SPX. I'll change the candlestick so that you all can see the trend. Okay, don't worry about this candlestick pattern. I will teach you all in the next session. But right now you can see the trend. So the market has dropped. Technically, RSI has come to oversold at this point. And where is this point? Somewhere here. Okay, this is where RSI has given me a oversold region. Now let's say RSI gave me a oversold region at this price here, and I take a buy. Trade from chart, limit order. The price was 3.2. Okay, so when the price came pretty much somewhere here at 3233, RSI is already indicating a buy for me, right? Because if you look at it, let me zoom that in for you. RSI has come below its oversold. So technically it is a good level to start gearing up for buy. But let's assume in the case where someone with a $10,000 account thought it was a good opportunity and invested just $10,000 at that point of time. Okay. And did not keep a stop loss. So technically we're going to keep a stop loss looking at the ATR. But in this case, let's say we took a buy because after all, RSI is showing oversold. At some point in time, it has to come back up. So let's assume that me as an investor do not keep the stop loss. So after I bought, which is at this blue line, the market came down, came back up a little bit. You can see it came back up a little bit, continued going down. Okay, continued going down even further, and it went down all the way till this level. Okay, now if I had to put a stop loss, I could have exited pretty much with a $400 loss, but because I did not use any stop loss or any risk management techniques, I ended up seeing a loss of $3,000 on one single trade. Okay, and most investors or most short-term traders always look at making quick returns. So for you to make a quick return, they use leverage. Now however, leverage needs to be understood very very carefully before you take leverage. It is not advisable to take leverage without understanding how leverage works. I will show you an example of a leverage trade, but it is not advisable. If you want to take a leverage trade, please do contact your consultant before taking any trades. Now, leverage is something which the platform offers. You have a $10,000 in your account. You can take an exposure of $20,000. You can invest an exposure worth of $20,000. In some cases, you can also take an exposure of even $50,000. Now, what happens for a short-term trader is he sees a oversold opportunity to take a buy at this blue line and to make a quick return. Let's say this green line is what the investor was looking to make, right? Basically, to make a quick return, the investor or the trader enters the market to make a return of $1,000, but did not keep a stop loss. Okay. Now, in this case, what happens is if you did not have a stop loss, it never came back above this buy price, and hence the market is dropping, and pretty much the client is losing $15,000 more than his account value. So technically, by the time market dropped to this level, the entire investment that the investor or the trader has put in has been wiped out only because lack of stop loss. Now let's assume in the case an investor or a trader took a position worth $50,000, which is very highly leveraged. But I'm just giving you this as an example because there are times where unknowingly you might end up taking a big leverage. So make sure every time your investment amount is higher than your account value, a stop loss is a must. So let's say the investor did put a stop loss. Okay, in this case, worst case scenario, yes, there's a big hit of $1,000 on $10,000. That's a 10% loss. But the 10th percent was much better than the entire account being wiped away. So this is where you need to keep a stop loss. There is a question on stop loss. Is in this situation, which level is ideal for a stop loss? Very good question. On SPX, I did not show you the ATR. Let's put the ATR back on. Now we understand ATR here. Let me zoom back. Yes. Okay, so this was the drop that we're looking at. Okay, now at this point of time, the ATR, if you can look at the ATR, let me close the RSI. I hope you all can keep this in mind. We are taking a sell, sorry, you're taking a buy over here because RSI is oversold. So I'm going to close RSI so you can see the ATR better. Okay, at this point of time, my ATR all the way from last December, Jan, Feb, it was showing an average movement of $32 a day. In a single day, it can move about $32. So technically, if you had to buy it at 3233, you should have a stop loss of 32. Let me just 3200, right? Because if it goes down by $30, it is best for you to exit because that is the average true range as per a daily chart. But now, if you were looking to buy SPX and hold on to it for a week, then you can look at it on a weekly time frame. Now, on a weekly time frame, you see the same level over here. You can still see the circle. I hope you all can see the circle. Let me make this bigger. And let me make this into a different color. Yeah, so you can see the circle. This is where we were planning to enter on a daily chart. But let's say my view is for me to buy and hold for maybe next 5 days or next 2 weeks. So in that case, my ATR is $73. So $73 basically is, okay. So I entered at, let's make it round figure so it's easy for you to understand, 3220. Let's say you entered at 3220. Sorry, 32. Okay. You entered at 3220 and you're going to keep a stop loss of 70. On an average, it's about 70 points. So I'll just make this round figure so everyone gets it as well. 700 points. Sorry, 70 points. I'm sorry, the system is acting a little. Okay, perfect. So you entered at 3,220 as per the ATR. If it goes down by 70 points, it is good time to exit. So in this case, you took a $50,000 exposure. You have kept your stop loss of $70 lower. And let me go back to the daily chart. Yeah. So this is where you had entered. Now, for the one who had asked me, how do you decide stop loss? Now, most of you all know how I decided to keep a stop loss of $70 lower based on the ATR. And because I had the stop loss, my loss on a $50,000 investment, although very highly leveraged, I still lost only $1,000. Now, let's say in the case where I did not keep a stop loss, nobody is going to take a loss lower than this because at that point of time everyone wishes that the market will come back, because RSI is showing you oversold, you will still anticipate market to come back up. But there have been cases where the market can be in oversold and keep going down and make a huge drop. And this drop technically in the market was roughly from the place you entered would have been 30% drop. So basically, a 30% loss is something that you could have avoided if you had to just keep a stop loss as per the ATR. So in short, what we are looking at doing with an ATR and RSI is RSI can give you a signal saying it is at overbought or oversold, but your ATR is more crucial because it will help you decide how much to keep your stop loss and how much to keep a take profit. Looking at the same example, let's say you're a very conservative investor. you do not want to take a loss of $1,000. So you can always reduce your exposure. Let's say you invest only $10,000. So in this case, if it came down by 70 points, you will lose only about $200. Okay, let's say you are even more risk averse, you don't want to take even that risk, then you can invest even lesser amount, only $5,000. So even if the market did drop by 70 points, you will still lose only $100. So the levels, the stop loss levels will never change, but what changes is how much you are investing and how much of risk appetite a single investor or individual trader is looking for. The ones who are going aggressive, who wants to make bigger profits, will take bigger exposures. Let's say someone takes $30,000 exposure, but the stop loss is still 70 points lower. So the maximum that particular investor or a trader would lose is $700, because the stop loss still remains in the same level. So I hope the risk management side of it also well understood by you all today. What I would recommend is, with whatever you have learned today, with the RSI, with the divergence, and with the ATR, please combine all three of these together and try and find opportunities, and do it on a demo account as much as possible, at least 10 to 15 trades on a demo account. You can look at various instruments. You can look at Nasdaq. Okay, if you prefer stocks, and try and do it on a daily chart, so you will find more opportunities. If you prefer stocks, you can look at good volatile stocks like Tesla. Tesla is not recommended because it moves a lot in a single day, but then for a practice, it's good. So you can see Tesla here. Tesla has gone to overbought. Yeah, over here. Okay. Here it's overbought. Time to take a sell. But please use your ATR to identify where to keep your stop loss. In this example, I will not show you how to keep the stop loss, but then when you're practicing, you can go to your ATR, find your ATR, then you can take your trade from chart. And for those of you all who are attending this for the very first time, if you do not have a consultant yet, do not worry. Once you open an account and once you have a consultant, he will take you through everything that I've taught you on a one-on-one basis. So all your questions will be answered more in detail, and we can do it on a one-on-one basis as well. So let's just take this last one as an example. Someone who is looking to short sell Tesla, they will keep a stop loss, take profit. Let's say someone invests $10,000, expecting the prices to drop. In this case, I'm short selling. If the prices drop, I make money. If the prices go up, I lose money. So let's keep a stop loss, 795. Okay. Now I've just randomly put my take profit and stop loss. Actually, I would give, okay. I think most of you all understand short selling. I hope you all understand short selling. For those of you who do not know what short selling is, basically, I'm taking a position towards the downside. If the market goes down, I will make money. That's why the green line. If the market goes up, I will lose money. Now, let's look at the ATR very quickly. ATR on a daily chart, it says that Tesla can move about $20. You can see on the right hand side over here. Okay, it moves about $20. Now if I'm looking at a daily trade, I will look at keeping $20 take profit as a target and $20 stop loss. But if I'm looking at a weekly trade, now on a weekly trade, I look at Tesla, it can move about $56. Okay, now let's say I am expecting it to move by $56. So Tesla right now is 730, sorry, 780. It can move about $56. So that means roughly around 750. Sorry, my system again is hanging there. Yeah, okay, 730. So that is about 50 points on a weekly time frame I'm talking about. At the same time, I will also keep a stop loss of roughly, okay, the system is not allowing me to keep stop. Okay, let me do this manually so it would be much better. Okay, so about 5,000 points on the upside. Okay, so technically Tesla in a weekly range shows me that it can move about $54. So I'm keeping a stop loss and take profit about $54 away from my market price. So in this case, the market price is 779. So if it comes down by $50, that is 729. I will make a profit of $640. Okay, in the worst case scenario, let's say Tesla goes up, I will make a loss about $640. So everything that we've learned today is all 1:1. You're risking about $600 to make $600. You can also fine tune that to risking about $300 to make a return of $600. So your risk reward becomes 1:2, which we will again cover in the next session, or your consultant will teach you how to do that. So in this case, anyone who have taken a short sell has kept a pretty good stop loss quite far away from the market. And in a week's time, if Tesla does come down by $50, the person on a $10,000 investment can make about $640. So this how you need to practice it on your own. If you have any more questions, please do get in touch with your relationship manager, and they will guide you in terms of how to go about using your platform. And they will also introduce you to your market consultant, and your market consultant can give you much more advanced training on one-on-one basis. I hope today's session was of much value to each one of you. Please do not forget to give us your review on Google. Please also do send in your comments if you like the session and if it was valuable for you. And if there is any feedback for me, please do write it in your comments, and I would take that feedback, and probably next time it would help me present a much more insightful session for you. Also, if there is any specific topics that you all are looking for, please do write that also in your comments. Thank you all so much for joining and having the patience to listen to me for 1 hour. I hope it was of great value to you. Thank you again. God bless. Take care.